Welcome to the Apartment Guys, where we dive deep into all things multifamily investing. Our mission is to educate, inspire, and empower real estate investors to reach their highest potential. Each week, host Tate Seamer interviews high-level guests from all over the industry who are sure to bring valuable, actionable ideas that will propel your career to the next level. Whether you're just starting out or a seasoned investor, you are in the right place. And now your host, the Apartment Guy, Tate Seamer.
Underwriting deals is such a major pain point for people. Most don't want to do it, and the people that are good at it are few and far between. That is why after 6 years of being in the industry and buying over 1,200 apartments, using my best-selling multifamily deal analyzer, I created Real Estate Lab, a full suite acquisition software for multifamily investors. We have built a product that helps investors automate their acquisitions and close more deals, all in a cloud-based platform. You can go to realestatelab.com and sign up today using the promo code TAG2 for 10% off your first 12 months. This is David Tupin. Thanks for listening.
Welcome, everybody, back. Another episode of the Apartment Guys podcast coming to you with a very special guest today, Mr. Ryan Lawless. Ryan is a fellow apartment syndicator and operator, and is just a terrific guy. He's based in Denver, but owns properties all over, and really looking forward to sharing this podcast episode with you guys, because I think you're going to get a lot out of Ryan's story. He's a great success story and super inspiring. So Ryan, welcome to the show, man. Appreciate you being here.
Thanks for having me, man. Big fan.
That's awesome. I appreciate that. You and I met through some mutual friends and fellow investors.
Yeah.
It's probably been, a year and a half ago, maybe?
Yeah, just about. Yep.
Yeah. And we at the time we were investing in the same markets and looking at the market together and we talked a little bit about potentially partnering up at some point, either in Utah or in Oklahoma City, where we both have property. So I felt like, when we met and had lunch, we really hit it off. I felt like this is definitely a long-term relationship scenario for us. And Chelsea loves you, and I love you, so appreciate you being here.
Yeah, thanks, man.
Yeah. So Ryan, if you would just share for the listeners kind of a little bit about your background, kind of where you come from, your story in real estate, and how you got to where you are.
Sure.
I think, that'd be great.
Yeah, it's been a long road. I grew up, born and raised in Jersey, about 45 minutes outside of Manhattan.
Okay.
Little town called Morristown. Went to school in Randolph, it's called. And at an early age, I've always been fascinated with real estate. I don't know. I don't come from a real estate family, so it was kind of an odd pick. But I went to school at Monmouth University in New Jersey for the real estate program. So knew at 18 that was my path. And, went there. It was the only school in the state at the time, at least, that had a program. So I went to Monmouth for that. And then I had a mentor my senior year of college, Pat Fasano, just the perfect kind of entrepreneurial developer, him and just a bookkeeper. I don't even know if the guy graduated high school. I actually got a start in Salt Lake. Was buying right before the Olympics and made a bunch of money, and then brought it back to New Jersey. And and he just kind of inspired me to be kind of a hustler and go out and start small and go out my own. So I bartended my way through college, was bartending at night while working for him. And it was just before I was turning 25, 2011. And I just, I needed something new. My parents have never left Jersey. I didn't want to be that person who never left. So I started looking at the next up and coming market and decided on either Miami, which was coming out of the recession, got beat up really hard, as we all know. And, kind of was, still East Coast on the water, which is what I was born and raised. So I was used to that. And it was that or Denver, and Denver was the complete opposite. No water, mountains, super up and coming city. Young kids were just starting to move here. It was like the next big thing. And I just decided to say, screw it. And kind of traded the water for the mountains. I packed my Jeep with everything I could fit and just drove out here. I had no job, didn't know a single person, didn't have an apartment. So I just wanted to, it's kind of, I call it my quarter life crisis. And came out here and yeah, and just first thing I did was, the one good thing about learning how to bartend is you could do it anywhere. So first thing I did when I got here was bartend at night just to kind of get some money through the door and started looking for properties. So I think it was later that year, 2011, I bought my first property. I started with $10,000. That's all I had.
Wow.
And my first property I ever bought was a $35,000 one bedroom condo in Aurora. And I bought it because I only had to put down $5,000. And I could still live with the rest of that $5,000. Yeah.
Wow.
So that's how I started, man. It's been a long road.
Yeah. That's such a cool story. And dude, we have a lot in common. Like, I moved.
Yeah, we were talking about that.
Yeah. I mean, I had the same exact scenario when I moved to Salt Lake. I didn't know a soul. I didn't have a place to live. I had just my car full of stuff. And it was certainly, I was 26. It was definitely a quarter life crisis for me, like
100%.
total reinvention.
Yeah. And, I tell young people all the time now, it's like, you got to go through it. I think you got to rip off the Band-Aid. You got to get uncomfortable. And I think that's part of life. And you learn a lot. I learned so much about myself that first year. Completely going outside my comfort zone. I'm the first person in my family to ever leave New Jersey. So it was this huge kind of awakening for me, and it completely changed my whole life.
That's so cool.
Yeah.
So cool. I mean, when you do that, it's like you're starting with a blank canvas and 100%. Nobody knows who you are. No, you don't have a history with anybody. You can really like reinvent yourself. And, 100%. And it's really exciting. I think, especially at that stage in life, when you're past college, you have an education and you had some direction with real estate. I had nothing. My only direction was skiing. Real estate didn't come on my radar till 2006. And but it's really cool that you followed your bliss, and so to speak, and really like stepped out and, like you said, ripped the Band-Aid off and just created a whole new life for yourself.
Yeah. And at the time, the way I thought about it was, well, what's the worst that happens, right?
Yeah.
It all just, the wheels fall off and I go back home and go back to the life I know, or who knows what's around that corner and what I could do. And it all just came down to this belief. And, I had no money. I had essentially no experience. 2 years in real estate's nothing. It's nothing.
Yeah.
Nothing. I knew nothing, but I just said, screw it. Let's give it a shot. And, what's the worst that would happen? So,
yeah, I mean, you end up back in Jersey where you started, right? I mean,
right.
That's not a horrible outcome. You learn a lot in the meantime. I kind of looked at my venture the same way. Like, I'm going to ski and do this for a year. But it could easily, in my head, I was like, this is going to probably shift into something a lot more long-term. And, and Denver and Salt Lake are fairly similar cities in a lot of ways. And, I fell in love with the mountains, and I can't imagine living anywhere else at this point. Honestly, I adore it. But so what was your strategy on that first was that a hold that you did on the first property?
I mean, the first 10 years of my career, again, started with no money. It was always about building that, compounding that to get to some point, you know what I mean? So starting with 10,000, my whole strategy with that first 5 was to flip it. And so my senior thesis in my real estate development class back in Jersey was on transit oriented development. So growing up in Jersey, you have the trains, you go into New York City. I mean, we grew up with that. We knew that. And so there was all this data already back east to show what transit oriented development and the values to those properties do. So one of the things about Denver that I love was that they were building the fast tracks. It's called the fast tracks program. So they were just building out this regional, light rail system. So what I did is that property was directly across the street from what was not even approved, but very likely going to be a transit stop. So I really bought it. I mean, it was cheap, but I also bought it because it was directly across the street. So I bought that. I had a really good feeling. It was obvious, that it was going to work out and they were going to approve the station. 4 or 5 months later, they approved it and I sold it. Literally, I think the week later, I had it under contract to sell it for $70,000. So I turned that 5 into like 35 or something, right? So from there, I went and I bought a house and I flipped that house. And it was all about doubling my money. And it was just getting to a point, which I don't even, looking back, I didn't have a number that I needed to hit, right? I just was trying to grow so I could start doing more and more. Start with the condo. I flipped a few houses, got out of that business really fast. I think to be a flipper of houses, you have to be really good with construction, and that is not me. So it just was not for me. Did well, but then I just decided. I actually fell into my first duplex in 2012, I think, and I just bought my first side-by-side duplex, and I did what you call in Denver is a party wall. So a party wall, essentially you split it off into 2 condos, never, for lack of a better term. And I sold each one. So I bought it from an out-of-state owner for $370,000, party walled it, sold each side for $380,000. And at that point, that was the most money I've ever made. And I just went and said, okay, this multifamily thing, I get it. I like this. It had the, it's obvious to say it, but it had the downside of, well, I could always rent them out. Whereas a single family, at least back then, it wasn't as obvious. So then from there, I started buying 4plexes. Then every deal just got bigger. From a 4, I bought an 8 to a 16 to a 20. That's been my path this whole time.
That's awesome. Yeah. So you kind of referenced the first 10 years, you kind of flipping that whole time and building your capital stack.
Yeah. I mean, again, looking back, of course, hindsight, I should have held, refinanced. But truly, Tate, for the listeners who are kind of getting started, I didn't know anything. Let me be very clear. I didn't know the strategy of the refinance and the cash out refinance. I didn't know what those things were. So I didn't know any better. And then, you start getting caught up in, well, I want to own 100 units or 400 units or 1,000 units. And you just keep thinking that flipping is the strategy. And, everyone's got different strategies and they all work. But I just kept flipping. The longest hold I had, my first, 9-10 years of business was 3.5 years.
Okay.
So, looking back now, knowing what I know and being who I am, would I have changed that? Yeah, sure. But you live and learn.
Yeah. It's such a progression in this space. Back then I can totally relate. Like when I started flipping in 2006, there was no Facebook, Instagram, Twitter, et cetera. YouTube channel wasn't really a thing as far as educational goes. Bigger Pockets wasn't around yet.
Nope.
So the whole BEER strategy, unless you maybe sought out, books, I guess maybe were the only thing that would have taught you back then to do it. There weren't podcasts, so I can totally relate. And we did the exact same thing for the first 7 years. We flipped everything. And, obviously if we had kept 1 out of 4 or 1 out of 5 of the properties we did, it would have been a game changer for us, because Utah just went through and is still going through just massive appreciation, crazy, 27% year over year right now.
Yeah.
And, you buy real estate and wait. Don't wait to buy real estate, but buy real estate and wait is a great takeaway to take from this episode, because it is super important to build your capital up and you want to build your balance sheet. And so I get that. And what I've learned, in the last 3 years of pursuing multifamily is you can do this with no money, given the right partners and the right key principals and sponsors of the loan. And, I encourage people in one of the last episodes I did to really evaluate, number one, your strengths and your superpowers as a person, as an investor, but also evaluate your resources. And whatever resources you don't have, if it's capital, you go out and you find partners. And the great news is now there are meetup groups and podcasts and conferences and virtual meetup groups and stuff where you can really network your butt off and meet those resources through the long-term relationships that you build with people. But again, that's just all mindset. It's like you said, at the time we were in the same boat. We didn't know the BEER strategy. I didn't hear about that till Bigger Pockets came out. And you know, our sponsor, Tim Waukee, he was BEERing when he was 16 years old. And that guy never sells anything. He's a machine. Yeah. And, you know, he's got $140 million portfolio right now. And his net worth is, you know, a third or more than that, I would think. And so it just shows you like what you can build. You know, flipping for me is a hard, risky paycheck, and you're not growing wealth typically in a flip unless you're riding a huge appreciation wave. So, you know, for listeners out there that are flipping or are thinking of flipping, I think probably, not to speak for you, Ryan, but like for me, I would really encourage you to at least consider implementing some sort of buy and hold strategy into your business plan. And that doesn't mean you can't flip, but you know, flipping on large scale is something that I've seen a few people do really well. Ruby Tinoco is a friend of mine in Charleston, and she has a flipping on autopilot program that she coaches, and she's really mastered the scalability of flipping. But multifamily, when you're buying 80 units or 100 units or 150 units at a time, you've got your scale and your leverage built into the deal right there. And you're not flipping 50 houses a year and getting 50 loans and managing 50 construction projects and all that stuff. I would say for both Ryan and me, it's like we really found this lane in the multifamily space that we love because of all the advantages that it creates, but particularly leverage and partnership. I think, you know, it's a team sport, and I know you brought in partners, and you and I are very similar in the fact that I can't swing a hammer to save my life. Like,
yeah.
I was the guy mopping and sweeping the floor when we were showing houses and cutting the grass, and you know, it was lots of wasted time. So I just said a lot. Any thoughts on any of that stuff?
No, I mean, listen, I agree completely. And another thing I should know is early on, I already said I had no money, but I also had no ability to raise money. I didn't come from money. I didn't have that world. So for those out there who might be saying, well, I don't have money, or or I don't have the access or the ability or the confidence, which I didn't have the confidence to raise money. That world was frankly intimidating to me. I've never stepped in a country club in my life, you know what I mean? So as a kid, so for me, I didn't know any better. So that's another reason I said, well, I have to turn the 10 into, 20 and the 20 into 50, you know what I mean? So, and what I would say for those maybe in that same position is, okay, start, if you don't have a lot of experience, get a proof of concept. And yeah, you might have to flip 1, 2, 3 deals, but then, start bifurcating that approach out, and, like you said, flipping it's a job. I mean, yeah, you might own the company, but all you're doing is making yourself a job. I mean, whereas, there's no wealth really in flipping. So if you need to, like me, if you start with nothing, you don't have much or resources to help you get started or a balance sheet, do what you can, start small, start with your own money, do a deal or two, and then you have a track record. Then you can go and sit down with confidence and sit in front of anybody and say, hey, I've done this. And even if it was, $100,000 deal, who cares? You did it. Nobody cares. And you start there, and then you grow. And then, like you said, maybe it's 1 out of 3, 1 out of 4. I don't know. Everyone's a little bit different, but, bifurcate the approach out and start doing the holds, because if I or you, if we would have held on, we'd be in such a different, situation at this point.
Yeah. So talk about what you guys are doing now a little bit, Ryan. Number one, like, tell me a little bit about your team and, your extended team, I guess, a little bit, your power team, so to speak. Tell us a little bit about how that works, and also like what kind of business and deals you guys are going after right now.
Yeah, so it's come a long way. My group is called Renegade Properties. It's actually a pretty new venture. I've spent the better part of the last 2 years helping a very good friend of mine, Adam Fenton, build Narrate Companies, which is a pretty dynamic development group here in Denver, and we're doing a lot of great stuff. And most recently, we decided to take different paths. We talked about having partners. I've had strategic partners throughout my career in various ways, as you have. And recently, I just decided I think I was done with the strategic partner route, and just I've learned a lot. The first 10 years of my career is learning who I am, learning what I'm good at, learning what I wanted to do, what I wanted to be. And so now I'm kind of on this path so I've built this Renegade Properties platform, which I'm really excited about. So we're a pretty small group, where we really focus on, is value add opportunistic acquisitions. So multifamily, mixed use. We have some commercial. I'm even under contract on a value add office deal. So, I really am a value oriented investor. I seek dislocation. I seek, I think we're both, our strategies are very similar. We look for that mom and pop owner off market that, that's really, dig far and wide to find that. And we go after that. And our strategy is pretty, standard. You go in, you reposition, you stabilize, and then you either hold or you don't. And then the second part of my business that has really ramped up over the last 2 years has been on the development side. So, which is newer. So I'm developing now. We're developing a little over in various stages, over 100 million in development. We have a 78 unit here in central Denver. We have a 131 unit with 6,000 square feet in downtown Colorado Springs. That's a 7-story deal. And then we are working on a 120 unit garden style deal in Colorado Springs too. We're very, very hot on Colorado Springs as a market, as the next up and coming market. So I've been very focused down there.
That's awesome. Yeah, I think you're onto something with that too. What I do know about that whole frontal range area is like, Denver's obviously continuing to blow up. And the thing about Denver that's so different than Salt Lake is you guys have so much developable land still left. I mean, you could just keep going out into the plains as far as you want, but people want to be close to the mountains too. And I think and they want to be close to a nice town and with all the restaurants and everything else. So I think Colorado Springs makes a lot of sense. It's probably still relatively affordable compared to Denver. Is that the case?
Yeah. I mean, Denver's gotten out of control, man. Yeah. Like if I was 2011 today, young me, I would not be able to afford Denver. I couldn't. And it's sad. I mean, that's a hard thing to witness over the last 10, 11 years. Because in my opinion, as someone who grew up near New York City, which New York City, you can't live there. The people who make the city run, the workers that, in the restaurants, all those things, I mean, they can't live here. I mean, it's terrible. Yeah. So now listen, Springs is not, I wouldn't say it's cheap, but it's getting there. However, it's much more affordable than Denver. Springs reminds me of Salt Lake, very much so. First of all, you're in the mountains. Denver is great, but the secret about Denver, if you haven't been here, is it's actually on a good day, an hour and a half from the mountains. Right?
Yeah, right.
Good day. Springs is right there, and it's been notoriously known, and I think Salt Lake was like this, as a very conservative place because the military. There's a lot of military bases there. Right. But that is changing so much, and it's early, so it's super fascinating to watch.
That's awesome. It seems like you've kind of captured a really cool niche there for yourself. Yeah. So 78 units, 131, 128. Are those all in development?
Various stages. Yeah. Our 78 and 131 unit are about to break ground sometimes second quarter. It's been a long process. The city of Denver, another thing that's going to hurt Denver is that the process here has gotten insanely difficult. What used to be a 12-month entitlement process, we're at 18, and it's going to get worse from here, I think.
That's tough.
Yeah. And, I mean, how do you underwrite when you're not even breaking ground for 18 months? Right. I mean, our construction costs have gone up, 20%, and they're just going up more. So it's been tough to navigate, but rents have helped us there. So yes, we're second quarter on those, and then our 120 units, probably fourth quarter.
Okay. Okay.
Yeah.
I know you have stuff in Oklahoma, excuse me, in Oklahoma.
Yep.
You have other existing multifamily projects around as well.
Yeah. So I own a deal in downtown Provo, which is called 63 Center right in downtown. I own a number of deals in Oklahoma City. I was at one point back in 2015, 16, it was actually the first market I entered before or after I left Denver, Kansas City. I'm very active in Kansas City again.
Okay.
On a contract on a deal and looking at expanding back out there. I'm just a big believer in that market. So, my thesis is pretty, I'm not jumping around all over the country. There was a time when I was going all over. I'm staying pretty close to my core. My rule right now as a small team is to be about an hour and a half flight. So I could do a day trip if I need to. So Kansas City, nice. Oklahoma City, and Oklahoma City is an acquisition only market. I wouldn't develop there. Kansas City. And then of course the Utah market that I'm very, it's hard, but I'm trying.
It is hard. It's an appreciation play, right? Like 100%. You can't cash flow in Salt Lake, but you can certainly improve force appreciation and maybe capture some organic appreciation depending on how long you hold it as well. Okay. So one thing I want to point out from way back at the beginning of the episode to the listeners, that you hear this common thread throughout almost every story that I've had on the show. And that is somewhere really early on in the process that, in this case, Ryan found a mentor. And that was key in moving him into real estate from college, from studying real estate to kind of taking on an entrepreneurial mindset. It sounds like, is that kind of how it went down?
Absolutely. Yep.
Yeah. So, we talk a lot about mentors and mentorship on this program. And we've talked in past episodes about different ideas, whether it's a Michael Blanc or a Jake and Gino type program or a personal mentor coach. Whatever it is, developing mentorships, and specifically, one key mentorship with somebody can really put you light years ahead of where you would be in a few different ways. Number one, you're going to adopt their mindset a lot faster, and you're going to start thinking like they think. And then, number two, they're advocates for you, right? So they're going to make sure ideally that you're not making any mistakes that they made in the past, and they bring that experience with them. And so you get to benefit from that. And so I think that's a big takeaway. Again, I know probably listeners get tired of hearing me talk about mentorship, but I'm just a huge believer in coaching and mentorship. And it's certainly moved the needle massively in our business. It was why we closed in 18 months, we closed on 572 units. And that wouldn't have happened without like a Corey Peterson in my life, who really gave us the confidence that we knew what we were doing, at least enough to go out and start making offers and taking down deals. So to switch gears completely from that, I wanted to highlight that. How are you pivoting, if at all, right now in underwriting and just in deal criteria in general, with the changing debt market specifically and inflation, and which is going to help rent growth, but interest rates are going up, so the debt cost is going up. Yeah. How are you pivoting? I saw you kind of sigh and take a big exhale.
I think we're all feeling that, right?
Yeah.
It is an extremely difficult and volatile environment. I think it's virtually, I was just at a conference with a bunch of debt brokers this past week, and it's virtually impossible to underwrite an exit. I mean, we're just guessing, right? I mean, to be honest, because we don't know where rates are going. And I think there's one common theme that we're, at least what these people think is we're definitely going to see, some say recession, some say correction, definitely a slowdown. So it's extremely interesting. I think there's going to be opportunity. I'm sure, we talk about this, is that There's a lot of bridge debt out there, short term, who the past couple of years, I mean, listen, everyone's made money, right? And a lot of people did it with short term bridge, super high leverage debt, and this rate increase and how quickly it's happened. I mean, that's the crazy part, how quickly and what I think they're saying another 4 increases potentially. I mean, who knows?
Yeah. And some of those could be like 0.5 or, 5 bips instead of 50 bips instead
which
of
is
25.
Crazy.
Yeah.
So, that could bring some opportunities. So first and foremost, I am very cautiously and actively kind of putting money aside to wait in case that happens. Because I think there could be some opportunity. Underwriting, I mean, listen, I talk about this a lot with other sponsors is, you can't, the rent growth has been real. I mean, through COVID, everyone's had double-digit rent growth, and that's the first time in history we've seen this. But what I do see a lot of sponsors, especially ones that are ultra aggressive or not very experienced, they keep that rent growth going. I'm seeing some people in certain markets underwriting 8% year over year, and I just do not think that's feasible. I cannot I mean, listen, man, historically the number is 3%. Like the conservative numbers, you underwrite. Now we're in an environment where maybe it's 4, 5, 6, whatever it is, but that's not in perpetuity, right? Like that's not here to stay. So I think I'm very data driven, and we look at that at Renegade. We're extremely data driven. We look at, so we are underwriting about 5 or 6% over the next year, I think, but then we're tapering it down. I think so. Maybe that's conservative. Maybe we lose deals. I don't know, but what we've seen the last year is not normal, and it's not going to be the norm going forward, in my opinion.
Yeah, I agree. And my feeling right now is that we're still very much in a buying window. It's got to be the right deal and pencil well. And for us, that means cash flow and appreciation, which is why we're in the markets we're in. But I think it's something that you like you said, I mean, underwriting an exit is I think you just go conservative, and you increase the exit cap rate somewhat. But the reason I think we're still in a window is because I think interest rates are still very low compared to, historical data and, where we've been in the past. And I think that's not going to necessarily stick around. Like interest rates seem to be spiking. And so, we just locked up a loan this morning on an acquisition we're doing in Columbus, and it was 4.25%. And
I mean, that's phenomenal.
Yeah. I mean, and so that's still out there, and like, who knows if in 2 months it will be. And so for me, the time is now. We're underwriting 4 deals currently in our office here, and we're still staying real aggressive. That said, I think you need to find sellers and brokers that understand what just happened or what's happening, and understand that values therefore are not quite as strong as they were a month ago or 6 weeks ago. And I know the good brokers I talked to, they're coaching their sellers on that. And because a deal that underwrote 6 weeks ago at 3.75, at 4.5, very well may not underwrite at all. So yeah, that's interesting. And it's going to be an interesting world going forward. I think that by nature of just being in existing multifamily, and in your case, development in a rapidly growing market, I think we're in a risk mitigated asset class. And we're also in an asset class that's a good hedge against inflation, because rents grow and NOI grows with inflation. And therefore your values go up. But if cap rates decompress a little bit, then at least you've got the rent growth and the cash flow. But 100%. Yeah, I mean, you got to be really smart right now. And I know some buyers are just sitting this out, and I don't know. I think, people make fortunes in recessions and downturns and soft markets. And So like you said, I think and hope there'll be some good opportunities coming up.
Yeah, and I think in our space, Tate, and I'm sure like this is your thesis as well, is, being in development, seeing the construction costs and where that's going and how it's getting out of control. And many believe that we're not going to see those costs go normalize back to 2019 levels. That's
Right.
just, we're in this new world environment, whatever you want to call it. The biggest thing is, for those out there who are maybe, they want to do workforce housing or whatever, value add apartments, is first and foremost, what we look at is buying below replacement cost. You have a strategic advantage over if your next door neighbor is a new construction building, they have to hit a certain rent to cover that cost. I mean, I'm looking at hard costs alone of $270,000 a unit in the city, and that's just only going to go up. So to be able to buy below replacement cost and to find, a value component in what you do, if you have those two things, you're going to be okay. Personally, is my opinion. You just have that strategic advantage, just right off the bat, and that puts you just in a better position if and when that softening or decompression does happen.
Right, and this is kind of pointing out the obvious, but the asset classes that you and I are in, you're probably building. Are you building Class A in your developments?
Oh yeah. We're talking $3 a foot rent type stuff,
right?
Because you have to. There's no, you have to.
Right. So, but your existing stuff is probably more Class C, Class B.
My existing stuff is, Oklahoma City, for example, which very well. We're talking $800-900 rents, which are some of the most affordable, maybe in the country. You know what I mean? So we're such a different approach. Which is why I love it. I mean, it kind of hedges our bets personally.
Right. Yeah. I mean, I feel I'm kind of naturally wired as an optimist, but I just feel like this is just an awesome asset class to be in for all the reasons we talk about all the time: cash flow appreciation, huge tax advantages, risk mitigation, hedge against inflation, et cetera. There's leverage, there's there's all kinds of benefits to this asset class, and it feels good at this point to me to own property that we own, but also be in this space looking for new opportunities to make an impact in people's lives. And whether it's our investors or our residents at our communities, it's like that's ultimately where the rubber meets the road. And if our investors are doing well and our tenants and residents live in, healthy, clean, safe environments, then hopefully we're doing something right. And that's really the idea and the goal here. Are you a goal guy, or are you a future goal kind of guy? Or, some people are like that. Some people aren't. How do you approach that?
Yeah, I'm very much into that. I learned that very early on in my life, that goal setting and visualization, all those things, meditation, those are things that I practice on a daily basis.
I love that. Yeah, I love that, dude. Like that's so inspiring to me. My question in relation to that was, moving forward, like, what's your vision here? You've got 3 developments coming online. You've got existing properties that are stabilized and hopefully stabilized and, doing well. What's the, what are the next 12, 24, 36 months like for you?
Yeah. Like I said before, Renegade's been a new venture, just kind of kicked it off this year. So we've been building that internally. Ideally, this year, my goal is to have 100 million in assets under management by the end of the year, which, we're tracking to be there, which is looking good. But I used to be someone who's very driven by, and this is when I didn't know as much, is a number of units or this much money placed or something. But I've learned through trial and error and making mistakes that that's not always the best, way to kind of measure, only because, at least me, I was, if my goal is to buy 1,000 units in a year or something, I would start to put that ahead of, obviously much more important factors of whether it's a good deal or if it's the right market or the right deal in the right submarket. So I'm really focused on AUM. That's really where I focus, as someone who now raises money like you. I mean, early on I did not raise any money, so it was a little bit different. So AUM is really important. Most importantly, I want to be best in class. The team, I expect and demand a lot, but it's because we want to be best in class operators, owners, developers, investors, and stewards of our investors' capital. So that's the most important thing above everything.
Yeah, I love that. Yeah, I'm looking at a book on I'm going to send you this book as a thank you gift, Ryan, for coming on the show. And you may already have read it or seen it, but it's Multifamily Investors Who Dominate by BEERY, BEERY.
Oh, yeah, would love to.
Yeah, and he talks about the elite investor, and that's basically what you want to become, which is, like you're saying, best in class is a perfect way of describing that. You want your brokers and your markets to love you and bring you deals and opportunities. You want your investors to love you and want to invest more with you. Any outreach you do, all your strategic partners, you're even down to your power team with your attorneys and your property managers and everything else. Like, you want to be known as excellent at what you do. And, the last year and a half for us of acquiring these assets and owning them has been a learning curve, very much so. And the things that we didn't do well 6 months ago or 12 months ago, we're getting better at. But I think patience is, I'm a big Gary Vaynerchuk fan, and he talks a lot about patience. And if you listen to Ryan's story and go back through this episode, things, he majored in real estate development at Monmouth and college, and then was bartending and started building his portfolio or building his capital stack, his bankroll slowly. And, for 10 years, you were kind of doing that and didn't really pivot into this space until after that is kind of how I heard things. And so, especially if you're 25 or 35 or 45, even or 55, you have time. It took us 18 months once we started buying to get to where we are. We're at about 35 million AUM right now, I think. And we'd love to be at 100 million AUM too. That's part of our vision moving forward. Actually 200 million AUM in 3 years is what we're targeting.
Awesome.
So yeah, but I like what you said about the unit count thing, because that was my metric early on too, is get this many units, they cash flow this much. Boom. And you're right. If you're trying to just stack units up, you can make bad decisions.
I mean, because you have a deal that's 70 units and you have a deal that's 150, and the 70 units a better deal, but you're looking at the unit, which it sounds obvious, but at least for myself, as a young guy who's, number one, I'm ultra competitive. I want to be the best at everything. And and to get back to your statement of, I like to say slow and steady wins the race, right? Yeah. I mean, it's not just, I personally, as very competitive, I would see people that on paper or look like they were blowing past me because they were doing all this and doing all that. And you just keep stacking up wins, stacking, brick by brick, and you build the best foundation possible. I mean, we hear this all the time, but it's true. You know what I mean? Mm-hmm. So that's just what I've been focused on. And I think that's the best path to, this is a long game. Real estate is a long game. Goes back to flipping, goes back to our first thing we talked about. I mean, you can flip and make, a couple bucks, and then what? I mean, it is look long-term. My purpose personally in life is to build a legacy for my family, the family who isn't even, alive yet. I mean, this is for them. Every decision, every day is, I think I have it on my wall. Think of the legacy that I'm building for my family. And that is exactly the way I operate. And it's the way I think I'm going to build the best in class company that I truly believe I can.
Yeah. Yeah. So listeners, that was Ryan's big why right there. And we actually haven't really talked a whole lot about your why and why your purpose and why you're in the mission that you're in. But you can tell that Ryan has a tremendous sense of purpose and meaning behind what he's doing, and is in search of excellence. And like, there's that book, The Four Agreements, and like, you're hitting all of them. You're doing your best, you're moving the needle. And I love your vision forward too. Like having the vision of what you're creating in mind while you're creating it is huge. We talk about our vivid vision that we created at Greenlight quite a bit. It's a 6-page document on why we do what we do and how we do what we do and who we are and what we're creating. And it's been really powerful for us and guiding our process moving forward. So
yeah, I think it's huge.
Yeah. Well, Ryan, we're just about out of time here. I want to ask you a couple things. What do you do to unwind? I'm just curious. How do you enjoy life and enjoy yourself?
Well, I have a wonderful wife and 2 beautiful boys.
Okay.
I don't know if it's unwinding because they're crazy, but I go and spend time with them. I'm really into, my health. So I do a lot of working out and exercising, just, not to get all buff, but just for mental health personally for me. Meditation, like I said, a lot of reading, just things to always kind of keep pushing that ball forward for myself, mentally, spiritually, all of them.
Yeah. I want to hit on the spiritual piece just real quick, because you and I have that in common as well. I meditate regularly, and it's such a game changer. How does your spiritual life kind of integrate into your business life? Can you put some words to that? Does that make sense?
I really try to focus. I mean, every morning, the first thing I do is I'm kind of making my pot of coffee is I meditate, and then I sit and I visualize. I visualize my life. I visualize my day, my week, my year. And to me, spiritual, that's how I, connect with, that's how I connect with what's bigger. So that's kind of my way. I know everyone has a different path. I would love to hear how you do it too, because I think everyone's path is different. And I'm always super curious to see what other people do. Because I've taken a lot of approaches from other people that have been really beneficial to me.
Yeah, no, I mean, it seems to me like you're doing a lot of the right things, man. Like, and what I know about this world and the universe and kind of like the law of creation and the law of attraction and all that stuff. It is so about regular practice of mindset techniques, whether that's meditation, visualization, journaling, or all of the above. For me, like, it's all spiritual, like the business, the partnerships, my physical life. Like you said, I'm way into my health and working out and skiing and mountain biking. And that's all, like, I take that stuff every bit as seriously as I take our business. Like, and so I love the idea of how you do one thing is how you do everything. And, Grant Cardone says, if you pee on the seat and don't clean it up, you're never going to get rich. So, so I look at it all as all like, and it like, it's the business itself really calls forth from me, like, my highest and best and my sense of doing things with excellence and with mastery. Right. And it's kind of an all day every day thing for me. And so I don't really delineate between like the spiritual and the business and the financial and the physical, because it's kind of all part of the same picture. Yeah. But yeah, so that's kind of how I look at it. I just do a real basic sitting meditation. Sometimes just 5 minutes, 10 minutes, usually more like 20. Yeah. And I just sit and watch my thoughts and kind of, just be present. Right. And listen to my thoughts, but not identify with them kind of thing. And it's really powerful. It really is. No matter what your quote unquote religious basis and foundation is, I think something like a silence practice is incredibly valuable. So
and in this world, it's very hard and rare to have that moment or those moments. And just mentally, it's just such, like you said, it's such a powerful practice. And it taps into things that you don't even always know exist, and it's opened up new doors for me, new opportunities. So I'm like you. I mean, I believe in the law of attraction more than anything it is unbelievable. I have anecdotes throughout my life of just creating something from within, truly. I don't know another way to say it. So I'm such a believer.
Yeah. Thoughts create things, right?
Yep.
Well, dude, on that, let's close this up. Do you have any final words of wisdom for the aspiring multifamily investor that's looking to take things to the next level?
Man, just believe, find a path, find what's best for you, and just go after that path and stay so hyper focused on that. Don't look over the fence. Don't look what other people doing and thinking you got to ping pong around or you got to change your approach. Listen to yourself, what's best for you, and go and just attack that day by day by day. And you will break every boundary you ever thought.
That's powerful. Yeah. We have no idea how limitless we are, in my opinion. And, we've all got hangups and constraints and things that get in our way here and there. But the truth is, I think with good personal work, you can clean those up and really integrate well and align with your highest and best self. And that's going to attract huge successes in life, whether it's your relationships or your business or your physical health, everything else, like it's magic. So
absolutely.
Ryan, I really appreciate this, man.
Hey, thanks for having me on, man. I've been a listener, and we've known each other a year and a half now. I've been watching you guys, and I know we're going to partner one day on this deal, and it was an honor. Thank you. Yeah, no, thank you. And listeners, thank you from the bottom of my heart for listening to another episode. If I say this often, but if you're really, if you're listening right now, you just listened to everything that Ryan and I had to offer, took some notes, maybe took a few takeaways. Like that's what Ryan was talking about, earlier in the interview about, tuning in and educating yourself and inspiring yourself through this digital mentorship, which is what a podcast can be. Mm-hmm. And that's what we aim for here. So with that, I thank you, Ryan. Thank you, listeners. And we'll check you on the next episode of The Apartment Guys. Take care. All right, thanks. Thanks, brother. Yeah.
Thanks for listening to The Apartment Guys with Tate Seamer. Tate and friends are grateful to have you as a loyal listener. If you like what you've heard, please subscribe, rate, review, and share with friends on your Apple Podcasts, Google Play, Spotify, or any other podcast platform. Also, check out Tate's YouTube channel for videos of many of these episodes and more. Until next time, take massive action steps and rock on.